Okay, it's Sunday night. I want to talk about preference shares for just a couple of minutes. This is a topic that most people won't look at because of the characteristics of preference shares. But what I like to do is, as I do with all my videos, is try to tap into my 35 plus years of investing experience and share with you some of the challenges that I've had in the past in different types of investments so you can learn from them. And if you have any questions, happy for you to leave comments down below and I'll reply to them on a daily basis. And as always, you subscribe to my channel if you'd like to be updated as and when I do my daily videos. Hit the little icon, bell icon next to the subscribe button, and you can be alerted when my timely videos come up. But preference shares, what are they and how are they different from common stock? And then real quick, why am I bringing them up to you? So common stock, they trade on the exchange, they get various dividends or not. Common shareholders go to the AGMs and vote, and you're entitled to profits and assets if the company is liquidated. Now there's something called preference shares. Preference shares, you don't get to vote at the AGM and you don't get to make multiples of your money if the stock performs exceptionally well. A preference share is like a bond. People buy preference shares when they worry about the market going down and they want to have dividend income. The thing is with dividend income is dividends can be cut. But with most preference shares, they have something that's called a cumulative and redeemable. And cumulative means that if something bad, horrible happens and they stop paying a dividend, then once they rebound, they'll have to basically make up for all the dividends that they owe. And then redeemable means they can, whenever they want, buy back these preference shares at par. And usually par is $25. As you can see here, there's a couple in here. There's a Chesapeake Energy, which is this one right here, that is redeemable at $100. So in the old days, they were all 25, but you can see some are different prices. Some are 25, some are 50, some are 100. Here's a $50 one here on Simon Property Group. And sometimes there's cumulative dividends. In other words, if the business loses money in a particular year and they don't pay, sometimes they have to make it up, sometimes they don't. Thing is with preference shares, they are entitled to the assets of the company before the common shareholders are. So these are a little bit safer, and so people buy them when they want dividend income, but they don't want the impact of a market decline. They don't want to lose their capital. Now here's the challenge with preference shares. If you look over here to the left side on this chart, this is Chesapeake, which is an energy stock. What happens, and a lot of people don't understand this, when private bankers recommend preference shares to their high net worth clients, they pitch it as a bond, which is going to do exceptionally well in a down market. What they don't tell them is that when there's contagion, when the market has fear in it, when there's a liquidity issue, these preference shares are not very liquid. And because they're not liquid, they have exaggerated moves when something bad happens. So let me just show you an example here with the Goldman Sachs. You can see here, this thing was trading back in February, it was trading above 27, and it's yielding almost 6%. And what happened was when the market crashed, there was a liquidity event, and people needed to raise capital, or they worried about Goldman Sachs going out of business. I'd say they were trying to raise capital. If you look here, this was trading around 26, 27, and investors are like, hey, I have nothing to worry about. Stocks go down. I've got this preference share in Goldman Sachs. I have nothing to worry about. Well, look what happened to this thing. It's redeemable at 25, and look what happens. This thing drops all the way down, and the 52-week low was $17.11. Now, if you look where it is today, it's bounced all the way back up. So you see this characteristics of what happens with these preference shares. So on the days when you're having a huge down day, what I do is I leave bids down below for small amount of shares, and when I start getting filled, I keep leaving smaller orders further down below. And I'll take as many as I can get. And you can imagine if this thing was yielding 6% when it was 23, when it was down here at 18, you're obviously yielding, it's going to give you a dividend yield significantly higher because of the stock price being lower when you bought it. So here's an interesting characteristic that when the market's crashing, you can actually go in and buy very cheap preference shares that will guarantee you a dividend 6%, 8%, 10%, 15%. Now there's always a risk, like anything else, that the business goes belly up. And that's what's happened here with this Chesapeake Energy bond. Oil prices have collapsed. They're going to 10. Watch my other video on where I think oil's going, and I explain the rationale behind it. But look what's happened to this energy stock. Now this one was a $100 preference. This is $100. And look what's happened to it. Even last year it was trading around 50, and now it's trading at 4. The dividend yield is 95%, but obviously they're broke, so they're not paying a dividend. But if they were paying a dividend, and if you could buy it at 4 instead of 100, you're going to be getting a 95% yield per year. So in other words, their dividend they were paying out was like what, $4, $4.50 a year was their dividend yield. So this is where it gets interesting. If you understand the business that you're looking at and you believe that the business is sound and has plenty of assets behind it, this is an interesting area for you to look at. It's a very boring market most of the time. As you can see the kind of yields you're getting going to be getting around 5 or 6 or 7%. When you start getting around 20 and above, you pretty much got to believe that there's very little chance that this thing is going to be able to keep paying a dividend, or there must be some serious issues there. But this is what you're looking for. You're looking for the typical kind of collapse in prices with everything else, and the characteristics of the preference shares changes from being a bond and protecting you from a stock decline. It becomes and behaves like a stock. And that's the sweet spot. You want preference shares that pay interest like a bond, but has a liquidity event when people desperately want to get out of it. And that's where you go in and buy those. So this creates an excellent opportunity to add some very interesting diversifying assets into your portfolio on the days when we have a big crash. So put yourself a list together like what I've done here. And I mean, there's obviously a lot of bank preference shares, but try to pick some from different industries and remember to go look at them on the days we're crashing, and then put very small bids in and then just scale down with it, because you just have no idea how far it's going to go. But if someone wants to get out, you should provide liquidity for them the same way market makers do, and you'll benefit handsomely from it. So there you go. Good luck.